Hello, hello, hello. Welcome to another episode 19 of Inevitable Wealth Podcast. It is I, Jacky, Petite Home, and I have Julian here, the co-hostess with the mostest.
Hello, everybody. Thanks for joining. We'll kick it off now.
Yes, today we're talking AI. Is it a bubble? Is it not a bubble? Capitalism, and also just the next investment cycle.
Correct. Big question we're getting a lot of, should I invest right now? Where should I invest right now? So really pertinent in today's world where tech is through the roof.
Yeah. So we're going to try to keep it quick, people. So, Julian, is AI a bubble?
Okay. Very direct. There's a complex answer. There's a few different things going on. It certainly could have more room to run, but you definitely don't want to put all your eggs in one basket, right? Similar to the 2000s and what we're looking at. There are going to be winners and losers, and it's simply how do we go about diversifying to make sure that we are not 100% owners of the loser. What would you add?
I'm going to quote a lot of Julian is a huge fan of investment history in the stock market. And he's always been explaining to families, and we talked a lot about it here, that we've been here before when you look at obviously the internet boom, the dot-com bubble that a lot of folks talk about. We'll dive into that more, or even like the railroad boom back in the 1800s. And also, if you want to go way back, electricity, right? There's always been some sort of disruptive innovation that brings excitement and euphoria, but also fear to a lot of people. So the biggest takeaway is innovation, right? Like the winners will stay here. Capitalism rewards those who can effectively deliver like the technology in the best way.
Exactly. And it's very different from something like the tulip bubble, where the tulip mania, right? The valuations of tulips were going through the roof, and there was nothing really behind it. Same with the Beanie Babies. There was nothing behind it. Now, yes, it's certainly unique. A lot of folks don't understand it, and the valuations are high, but the potential outcomes are also very high, right? Things can go very well. There's going to be winners and losers. It's not a pets.com type scenario. And there's very real spending going on, which we'll get into, right? It's not all smoke and mirrors. There's very much real investment in this sector. And that sector leads to hard assets, right? Like data centers, which we'll talk about, and energy, right? A very much lesser known winner this year, where folks haven't been paying as much attention, but energy is up. So a few different things we can touch on. What would you add, and what comes to mind when it comes to the physical infrastructure?
Yeah, I think also we should talk about AI a little bit more, because it is a lot of folks are probably already getting tired of hearing AI. There's a lot of the square peg in the round hole that's going on out there. But it's not really just software. It's also like the physical, like the data centers that Julian was talking about. Like I don't remember what the exact number is, but it's a lot of billions, right? 100 or 200 billion.
I have global data center spending is estimated to exceed 590 billion this year.
Way off. 500
maybe
billion. Yeah.
corrected by somebody who knows a little bit more than me. But 590 billion. So very real spending. And that goes to things like servers, generators, cooling systems, cement, right? Copper, chillers. I don't know what that is. I think it's probably self-explanatory. Switch gear. Don't know what that is. Seems very important. A lot of spending towards that. But they're hard assets, right? And that's important to note. It's not all out in space, right?
Yeah.
It's building these things, the jobs that come with it. And then behind that, the energy that powers all of these and the cooling towers and things like that well into the foreseeable future.
Yeah. And we always like to use the metaphor picks and shovels, right? During the gold rush, folks that just sold picks and shovels did well. And when we think of an industry like this, it is far reaching. So we already talked about utilities, energy is going to go up, semiconductors, engineering, materials, construction. This spending has kind of echoes and rifts into other industries and sectors as well.
Exactly. And nuclear also comes into play. That's something that's being increased as far as investment. especially with the need that's very clearly going to increase in terms of power, right? And this has happened before when the internet came about, right? There was a lot more need for power, and they just built the power. They built it into the system so that we had more.
And we get this probably the most common, like, is this a bubble? A lot of folks who are old enough or remember or know the history of the dot-com bubble. So let's talk about that specifically just quickly. Um, the dot-com bubble, I always like to remind people that yes, it was a bubble. A
Mhm.
lot of the earnings and like the forecasts where some of these companies were
Yes.
just
Clicks do not equal dollars.
yeah,
Pets.com was the most notable.
yeah,
Not relevant anymore.
yeah.
Granted, I at least haven't been on it. But yes, very different where they were equating clicks with dollars and money, and it's not the same thing. Whereas now there's a little bit more revenue.
Yeah.
The companies we talk about, I mean, Meta, Nvidia, they make billions and billions of dollars.
Yeah,
So
yeah.
there's a little
So
bit of a
there's
difference
actually
there.
dollars moving. And also something too, I'd like to say, when we look at the dot-com bubble, yes, most of those companies failed because they were evaluated in outrageous,
Mhm.
earnings to price ratios. But basically, there's a lot of companies that came out of that dot-com bubble that we don't remember, right? Like Amazon and Apple and Microsoft and eBay. So yes, the AI, what we're gonna see as time goes on and as the investors and people start to really lock in to see who's doing it right, we're gonna see losers and winners, point blank. So, for I guess short-winded say is like it's definitely not a bubble.
Mhm.
I guess not for now. But like any innovation, we're gonna see winners, we're gonna see losers, and it's important to keep on
Mhm.
top of who's who,
Yes.
basically.
Yep. And not a bubble doesn't necessarily mean it can't be overvalued. There's certainly going to be names that are overvalued. For example, I don't know if anybody has noticed, but over the past year, 18 months, a lot of companies with no affiliation with AI have added some terminology to their website, their domain name, or their corporate, whatever it may be, that says they are an artificial intelligence driven cement company. And that has led to an increase in their stock price, even though it essentially means nothing. So some companies, yes, do not have anything behind the scenes. So you don't necessarily just want to buy everything related to AI. But when you look at investment, and you know what, Jackie, I'll give you this one. Where would you be looking as far as, let's say you got $500,000, you just sold your business, you just essentially liquidated some company stock. Where are there opportunities beyond just AI? Is the market frothy? What are you thinking?
So when you actually, that's a good question. So of course, this is not investment advice, just in case for folks who don't listen all the way at the end for the
Mhm.
disclaimer. But when you take out of the Magnificent Seven, those top seven stocks, like there is definitely, well, I always like to say there's enough gas in the tank to
Mhm.
run. We're 3 years into a bull market, the average bull market 7 to 10 years. So even outside of the tech, outside of the AI, even just at a broad market perspective, like a well-diversified portfolio will still do well.
Mhm.
And then also shout out to International. International, I think, as we're recording this in November, it is up year to date. I think just under like 26 or
Yeah,
27%.
about 26%.
Twenty-six
Yeah.
percent.
Yep.
So AI is not the only opportunity out there, and don't let that blind you from just investing in a strategy that is going to pay off not over the next 1, 2, 3 years, but over the next 10,
Mhm.
15, 20 years, because that's really it's the long view.
Exactly. And so when you look at valuations, you look outside that tech space. Currently, right, if you take out the non-tech portion and the non-Mag 7, the S&P 500 trades at around 19 to 20 times market cap weighted earnings. What that means, to put it simply, is those are entirely reasonable valuations. And historically, right, we do have a little bit more room to run. Doesn't mean it won't be choppy. It always is, right? It's the price of admission for the growth that we've seen and will continue to see in the long term. But 19 to 20 times earnings, not bad at all.
Yeah.
International going into the year was 14 or 15. Now it's probably around 17, give or take. So that also is not necessarily a bad place to look. especially AI affects all these companies in a way that it could make them more efficient, right? So in the past, companies were not valued at 20 times earnings because they were less efficient, right? They had needed 1 million people to make $1 million. Now you need one person.
Sure.
So things do change over time as far as valuations as well. But expansion still has legs. Will be choppy though. Let's say over the next 18 months we see some choppiness. What should folks be looking at, considering, and doing along that?
Well, it's we've said this once and said before, right? It's the long-term view. We definitely shouldn't mistake volatility for vulnerability. It is absolutely natural and absolutely expected for the market to be up and down. We always like to tell our families, it's not a question of if, it's a question of when, right? Corrections are natural, pullbacks are natural, it's going to happen. So when you see these in the future, I always look at those as opportunities to buy into the weakness. So under the assumption that you're in again, diversified portfolio that aligns with your financial plan, we see pullbacks, you have cash on the side, put it to work. You've been waiting for some sort of weakness, put it to work. Yeah, I don't know. Anything to add to that?
The only time I would say, that was quick. That was too quick. The only time corrections are bad is if you're not prepared for them. There will always be another one on the horizon. When's the next recession? It might be 6 months, might be 18 months. They are normal. I spoke to a family yesterday. They're on the cusp of retirement, 64, 65. And the conversation is, if there's a recession every 4 years, that means we're going to see, easily 5 to 10 more in the rest of your lifetime. So it's not an if, it's a when, and we need to be prepared for that. So knowing that if you're still working, you have an emergency fund, especially if there is a recession, there can be a risk of job loss. If you are not working, making sure that you do have an emergency fund commensurate with the amount of risk you're taking, right? And then when you do see opportunity, if you are looking to invest, which we always are, not necessarily throwing it all in at the first sign of a 2% drawdown. We haven't seen real volatility this year. We haven't seen real volatility last year either. I guess a little bit, but not all that much. And so if the market's down 5%, don't necessarily put in all of your money that day, right? Piecemeal it, make sure you have enough on hand, and just take it day by day. Because, if you remember COVID, the market was up and down 5 and 10% every single day for March. That's not a fact, though. Don't quote me on that. But I do remember we were sitting next to each other, and it was just whipsawing all over the place.
That was such a fun time, wasn't it? Wasn't it such a fun time?
It was. It was. A lot of opportunity out there. A lot of the folks that were working with us then did extremely well.
And a direct question, too, or a direct answer. If you do have a big lump sum of money, it wouldn't be a bad idea to, what we've been doing is just hedging our bets. Dollar cost, just using round numbers. You have 500,000. You just sold business, you just rolled over something, whatever. Dollar cost average, right? Put maybe, do a ballast, put a good chunk up front, just in case the market does run for the next 6 or 7 months. You want to miss on that appreciation. And then dollar cost the rest. Because when you dollar cost average, it's great. You take advantage of the short-term dips in the market. And then also, just from a qualitative perspective, you feel a little bit better, right? Because I don't know how many times we've had families move over money or invest just lump sums, and then almost all the time the next day the market's down like 1 or 2%, which is short-lived, but it's always like, great, So
you're never going to nail the top or the bottom.
Never.
Nobody can. You can never sell exactly at the top or buy exactly at the bottom. So you got to figure out what you're going to be comfortable with as far as being a little bit wrong. Because the worst thing you can be is a lot of bit wrong, where you sell at the wrong time, buy at the completely wrong time, and just put all your eggs in the one basket. But if you kind of navigate, you work with an advisor, or you're working with us already, you're in great shape.
So in closing, give us the TLDR for AI, Julian.
Still plenty of opportunity as far as investments across the world. Don't necessarily overbuy the hype as far as strictly buying NVIDIA or strictly buying Tesla based on autonomous vehicles, because it may go well, or you may blow up your retirement, which is not good. And then third, expect the expected, which is drawdowns, which is volatility, and it's going to happen. So just be ready for it.
Yeah. And as always, stay invested for the long term, right? Keep your emotions in check. That's the positive and negative, right? Don't get too euphoric. Don't get too, overly excited, but also don't get too fearful, right? Innovation is choppy. It's not just like a straight line. As a humanity, we're figuring out this AI innovation thing. So there are going to be setbacks, and that's natural, but that doesn't necessarily mean, hey, AI is out the window. And there's a quote here, Julian, you want to read that you had saved here?
Sure. Every industrial revolution starts with a little irrational enthusiasm, but history's clear. Capitalism always finds a way to turn big ideas into bigger living standards.
Oh, bars.
I don't know who wrote it. I have it written down.
Well,
but we could say I said it.
Yeah, Julian said
unless that's illegal.
I don't
know. All right. Well, thank you all for joining us. Jacky, take us away.
Well, thanks for listening, everyone. Please share if you found anything here helpful. And also, we do appreciate the feedback of topics we should discuss. So we always have an ear out for that. Have a wonderful fall and winter, and we will talk to you soon. Take care.